The income statement is a little more complex than what was taught in accounting principles. So this will cover the complete expanded version. It goes a little beyond the multi-step income statement. There also has to be some classification of that multi-step. So yes, there is even more. So first, what are the components of net income? Well, in intermediate accounting, you're introduced to continuing operations, income from discontinued segments, and income from extraordinary items or events. So in principles, you just had net income, but now you learn you must classify where the net income came from. And that is for better understanding of earnings quality. Now, a way to remember this, it must go in this order. First, you have to show income from continuing operations. So notice it's in alphabetical order. But why? Well, the income statement is a useful in predicting future profitability. But in order to do that, you have to show the components separately to get a true picture of the company's ability to generate future earnings. This goes along with the conceptual framework's predictive value. Components that will not continue into the future will no longer contribute to future profitability. So if you have anything discontinued or extraordinary, it's only happening in this period. It's not going to be a predictor or an indicator of future profitability. And there are special rules that go along with how do I determine how to classify this as continuing, discontinued, or extraordinary. So first, income from continuing operations, revenues, expenses, gains, and losses. Of course, you'll have income tax expense, and the special rule for the advanced multi-step income statement is you show it gross and net on the statement. It's going to be different for the other sections. Discontinued segments. This can be held for sale or already disposed of. And the handling is similar, but it's just a little different. It can be either. It's either or. And this is shown on your statement only net of tax, where continuing operations income had to be shown gross and net. Extraordinary items. You will hear the term unusual in nature and infrequent in occurrence. This is not one or the other. It has to be both. It has to be both unusual and infrequent in order to be classified as extraordinary. If it's only one, it goes in continuing operations. And this also must be shown net of tax. Net income, remember, it equals income from continuing operations, income from discontinued segments, and income from extraordinary items, and you must classify it this way. But there's a little bit more. This is just net income, and in accounting principles, you were taught that's your bottom line. But what about other comprehensive income? This is something you were introduced to very briefly in the middle of your accounting principles courses when you looked at accounting for investments by corporations in other corporations. If you recall, the trading securities available for sale and held to maturity, some of that had to be adjusted to equity, some of the unrealized gains and losses. That's just one component that goes into other comprehensive income. Now, what is confusing is the terminology, comprehensive income and other comprehensive income and accumulated other comprehensive income. These are not the same. Abbreviated CI, OCI, and AOCI. So what are they? What are the differences? Well, back to net income, that's revenues minus expenses plus gains minus losses. That's net income or loss. These are transactions with the owners that actually did occur. Net income is going to increase. It's going to be an increase to the value of your company. But you want to be able to look at this and look at your full earnings, and it should equal the change to the true value of your company. The true value of equity changes over time because of fair market value changes. Now, even though you must comply with historic cost, that accounting principle, that GAAP principle, FASB does allow fair value adjustments as long as they're kept separate from net income, and that way you can track it so you're not hiding things and making your income appear larger just from your ordinary operations. By doing these fair value adjustments, it gives you a better picture of the net worth, the true value of a company if it were sold today. So comprehensive income, remember there were three different ones. The first one, what is comprehensive income? It's simply net income plus other comprehensive income. Other comprehensive income are adjustments to fair value. It's more of a what-if effect. So net income is what really happened. Other comprehensive income are adjustments to show the users of your financial statements what the fair value is. These are not actual transactions, but equity should change because the overall value changed. So net income did happen. Other OCI did not happen. And this is just a way to think of what's the difference between a realized gain or loss and an unrealized gain or loss. Because in the end, you want the true earnings, net income plus other comprehensive income. You want your comprehensive income to equal the change to the true net worth of your company. So looking at other comprehensive income, what is it? Well, there are four main components. Two are taught in intermediate accounting, but these actually are not until the second semester. The other two components are not taught until the senior level if you're working on a bachelor's degree in accounting, looking at derivatives, looking at foreign currency. So, but it is important to know in intermediate accounting what the four components are. And what about the income statement presentation? Well, you have income from continuing operations before taxes, then you must show income tax expense, then you show income from continuing operations. That is your after tax. So this is showing it gross and net. The next classification on your income statement on that multi-step is income from discontinued segments, but it's shown net of tax. Income from extraordinary items, shown net of tax. Then you have net income. Then you show other comprehensive income, and these are net unrealized holdings, gain and losses from investments, from pensions, from derivatives, and from foreign currency translation, not foreign currency transactions. That's different. That gives you total other comprehensive income. Finally, the final number is comprehensive income. It's just the terminology that can get confusing. Total earnings now should equal your changes in your net worth. So you're maintaining historic cost, but you're also able to show what fair value is. The key here is to remember, don't forget comprehensive income includes net income. And there are different terms. Net income plus OCI equals your full earnings, comprehensive income. And what is other comprehensive income? Those are your fair value adjustments. This is a temporary account that closes to accumulated other comprehensive income on the balance sheet. So the two accounts you'll have on the balance sheet are retained earnings and accumulated other comprehensive income. It's a permanent component of equity. And you can see how the closing process will adjust income and loss. Finally, shareholders' equity, how is it shown? If you had preferred stock, that should be listed before common stock. Accumulated other comprehensive income comes below retained earnings and before the final reduction for treasury